63. That's the age that decides what you'll pay for Medicare, not 65 when it starts. 63, 2 years before you sign up for anything, because the amount they charge you isn't based on what you earn when you enroll. It's based on your tax return from 2 years earlier, and almost nobody finds that out while 63 is still in front of them. And there is no letter. Nothing arrives at 63 saying this is the year that counts. Here's why this catches people who plan carefully. Everything about Medicare is taught around one number, 65. That's when you're eligible. That's when the enrollment window opens. Every article, every seminar, every conversation with a friend who went first, all of it points at 65. So people organize their thinking around 65, and they make their big financial moves in the years before it, precisely because they think those years don't matter yet. Sell the rental now while there's time. Do the conversion now before the required withdrawals start. Cash out the shares now and get it out of the way. Every one of those is a reasonable decision, and every one of them, made at 63, quietly writes a number on a bill that arrives at 65. The system isn't hiding it. It's published. It's just that the year it matters and the year you learn about it are two different years, and by the time you're paying attention, the year that counted is already behind you. 3 people are about to turn 63. Let's follow all 3 of them to 73. One thing before we start. I'm not your advisor, and I don't know your income, your state, or your situation. What follows is how the mechanism works, not what you should do. I'm going to describe how the thresholds behave, but I'm deliberately not giving you the dollar amounts because they change every single year, and I'd rather you look up the current ones than trust a number from a video. Ed is 63. He owns a rental property he's been tired of for years, and this is the year he finally sells it. It's a good sale. It's also, in tax terms, the largest single year of income Ed will ever have, and it lands entirely in 1 calendar year. Ed is not being reckless. He's doing the thing everybody told him to do before retirement. Simplify, get out of the landlord business, stop taking 2 a.m. phone calls. Loretta is 63. Loretta has been reading about Roth conversions, and everything she's read says the same thing. The low-income years before your required withdrawals start are the cheap time to convert. That advice is genuinely good, and we've talked about it before on this channel. So, Loretta does a large conversion this year, on purpose, for sound reasons. And Sam is 63 too. Sam does nothing unusual. Not because he planned it, because nothing happened. No sale, no conversion, no windfall. His income this year is ordinary and low. Sam is about to look like the smartest of the 3, and he made no decision at all. Here's the mechanism, in plain terms. Medicare doesn't charge everyone the same. Above certain income levels, an additional amount gets added to what you pay each month, and the income they look at comes from your tax return 2 years back. So when Ed, Loretta, and Sam turn 65 and sign up, the system doesn't look at their income at 65. It looks at 63, at the property sale, at the conversion, at the ordinary quiet year. Now, why on earth would they use a 2-year-old number? There's an honest answer, and it's not a conspiracy. When you enroll in the middle of a year, your income for that year doesn't exist yet. It isn't finished, and it hasn't been filed. The most recent, completed, verified tax return available is the one from 2 years earlier. So that's the one they use. It's administratively sensible. It's also, for a new retiree, almost perfectly wrong. Read that again, because it's the whole shape of the problem. The 2-year lag means the system looks at you during the years when you were still working, or when you were doing exactly the big one-off transactions that people do right before they retire. Your income at 65 might be 1/3 of what it was at 63. Doesn't matter. The number they hold is the old one. And this is the part almost nobody says out loud. The lag doesn't just apply once. It applies every year, forever. The premium at 66 looks at 64. At 67, it looks at 65. At 75, it looks at 73, which, if you've been following this channel, is the year your required withdrawals begin. Every year of your retirement has a shadow year, 2 behind it, and almost every financial decision you make casts that shadow forward into a bill you won't connect to it. Ed sells the property. Loretta converts. Sam does nothing. All 3 of them file their taxes the following spring. All 3 of them feel fine. Nothing happens. This is the year that matters, and it is completely uneventful. Still nothing. All 3 are a year from Medicare, reading about the enrollment window, comparing plans. None of the 3 is thinking about a tax return that was filed over a year ago. Ed has already spent part of the proceeds. Loretta has forgotten the exact size of her conversion. The evidence has faded, and the consequence hasn't arrived. Now here's the thing that makes this genuinely different from ordinary tax, and it's the detail that costs people the most. Most of the tax system is gradual. Earn a bit more, pay a bit more on that bit. It's a slope. This isn't a slope. It's a staircase. The income levels that determine your Medicare surcharge are thresholds, and they behave like steps. Below a threshold, you pay one amount. Cross it, by a lot or by a little, and you're on the next step entirely, which produces a situation that feels genuinely unfair the first time you meet it. Being $1 over a line can cost you a full tier for 12 months on every monthly premium. Not $1 more, a tier more. And here's what makes it worse for our 3. Ed didn't cross a line by $1. He cleared several of them because a property sale is a large, lumpy, one-year event. Loretta may have crossed one she didn't know was there, doing something an advisor recommended. Neither of them was told there was a line at all. This is why the phrase you want in your head is not, "Will this raise my taxes?" It's, "Where does this put my total income for the year, and is there a line near it?" Those are different questions, and the second one is the one that decides this. Let's talk about what actually counts, because people get this wrong in a specific way. The income figure used here isn't just your salary or your pension. It's a broader measure. It picks up things people don't think of as income at all. The gain on a property you sold, the amount you converted from a traditional account to a Roth, withdrawals from tax-deferred accounts, capital gains from selling investments, and, this is the one that surprises people, certain interest that's exempt from income tax is still counted for this purpose. So somebody can hold an investment specifically because the interest isn't taxed, and still have that interest push them toward a threshold here. This is the part that breaks people's brains. You can do everything right by one rule book and trip a different one, because the 2 rule books don't use the same definition of income. And notice what this does to the 3. Ed's problem isn't that he made a mistake. It's that a single transaction he'd been planning for years happened to land in one calendar year. And this system only ever looks at calendar years. He could have split it. Nobody told him there was a reason to. But hold that thought, because there's something that happens later that is worse than any of this. And it doesn't happen to Ed at all. It happens to somebody who did nothing. All 3 enroll. All 3 go through the same 7-month window, compare the same plans, make the same decisions. And then the amounts arrive, and they are not the same. Ed's is high, a tier or more above what he expected, because the system is looking at the year he sold the property. Loretta's is elevated too, from the conversion. Sam, who made no decision whatsoever, pays the base amount. Ed calls to ask whether there's been a mistake. There hasn't. Now let's sit with what just happened, because the mechanics of it are the reason this is so hard to see coming. Ed sold a property at 63. The consequence arrived at 65. 2 full years, with nothing in between. In those 2 years he retired, moved money around, filed another tax return, had a birthday, went on a trip. By the time the higher premium shows up, the sale is old news. It's finished business. And nothing in the notification says, This is because of a property you sold in the spring of 2 years ago. It states an amount. That's all it has to do. Cause and effect are separated by 24 months, and nobody joins them up for you. Which is exactly why people conclude that Medicare is simply expensive, rather than that a specific decision made it expensive for them, temporarily. And that word, temporarily, matters more than anything else in this video. Here's the good news, and I want to give it to you plainly because it's the most reassuring thing in this whole subject. It's recalculated every year. This is not a permanent verdict. Ed's high premium is based on 63. Next year, the system looks at 64. An ordinary year, no property sale. So Ed's amount comes back down on its own, without him doing anything. Loretta's does the same. The damage from a one-off event is generally a one-year problem, not a life sentence. If you've been sitting there getting anxious for the last 10 minutes, that's the sentence to hold on to. What it is not is a problem you can ignore, because the year it hits is a year of real money, and because there is something you can do about it that almost nobody does. There's a detail here that catches almost everyone, and it's worth 30 seconds because it changes the size of the number. Most people think of this as one surcharge on the main part of Medicare, the part that covers doctors and outpatient care, and that's where they see it first. But the same income test also applies to your prescription drug coverage. Two separate additions, calculated from the same 2-year-old tax return, arriving on two different parts of your cover. So somebody who has worked out roughly what a higher tier costs them has often worked out half of it, because they only counted the piece they noticed. And here's the compounding annoyance. The drug coverage surcharge applies even if you buy that coverage from a private insurer rather than directly. You pay the insurer their price, and then you pay the surcharge separately. People find that genuinely confusing the first time because it feels like being charged twice by two different organizations for the same thing. It isn't a mistake. It's two parts of the same system, both looking at the same old return. So far, this has all been about a thing that happens to you. Let me spend a few minutes on the part you actually control, because it's smaller than people hope and bigger than they think. You don't control the thresholds. You don't control the 2-year lag. You control which calendar year your income lands in. That's it. And it turns out that's quite a lot. Take Ed's property. A sale that completes in late December and a sale that completes in early January are, for this system, two completely different transactions. Not because the amount changed, but because it landed in a different year. And this system only ever looks at years. There are sales where the timing genuinely can't move. But there are many where it's a matter of a few weeks, and where nobody at the closing table has any reason to raise it. The same logic applies to Loretta's conversion, and it's more powerful there because a conversion is entirely voluntary in both timing and size. One large conversion in a single year can push through a threshold. The same total amount, spread across 3 or 4 years, may not touch one at all, and it's the same money doing the same job, just handed over in slices. That's not a trick. It's the difference between one lump and several. And there's a third one people never think of. If you're going to have a genuinely low-income year, that's an asset. A year with no salary, no big sale, and no conversion is a year with room in it. Room you can use deliberately for the transaction you were going to do anyway. Here's the part almost nobody puts together. Most people plan their retirement transactions around income tax, and income tax rewards spreading things out too. So the two calculations usually point the same direction. Usually. But not always. And the year they disagree is the year to have somebody look at both at once, rather than optimizing one and discovering the other in 24 months. Here's what almost nobody knows. If your income has genuinely dropped since that 2-year-old return, and for a new retiree it almost always has, because that return is from when you were still working, you can tell them. There's a form for it. It's called SSA 44, and it exists for exactly this situation. It lets you report what's officially called a life-changing event, and retirement is on the list. So are things like the death of a spouse, a divorce, or the loss of a pension. You file it, you attach evidence of the change, and they can recalculate using your current situation instead of the old return. Let me be honest about the limits, though, because I don't want to oversell this. It isn't for people who simply had a big transaction. Ed selling a rental property is not, by itself, one of the qualifying events. It's for people whose ongoing circumstances changed. Stopping work is the big one, which means the person it helps most is the person who retired at 64 or 65 and is being charged based on a full working salary at 62 or 63. That is an enormous number of people, and most of them never file it. They see the amount, assume that's what Medicare costs, and pay it, sometimes for years, because nothing in the letter suggests there's a form. One more thing about that form, because there's a scenario I haven't covered, and it's more common than it should be. The determination is simply wrong, not unfair. Wrong. Built on a tax return that was later amended. Built on a figure that was misreported, or applied to the wrong person entirely, which happens with common surnames more often than you'd hope. And here's the first confusion people hit. The letter doesn't come from Medicare. It comes from Social Security, because they're the ones who hold your income information and calculate the amount. So somebody who wants to query a Medicare bill calls Medicare, and Medicare tells them it isn't their decision. That single misunderstanding sends people in a circle, and a fair number of them give up in the circle. There is a proper route. You can ask for the determination to be looked at again, and if you disagree with the outcome, there's a formal appeal beyond that. It's the same machinery that handles any other disagreement with a benefits decision, and it exists precisely because these calculations sometimes go wrong. Read that again if you've ever assumed a government figure is final because it arrived on official paper. A calculated amount is a calculation. Calculations can be based on the wrong inputs, and there is a defined way to say so. 2 practical notes. The letters carry deadlines. There's a window for asking, and it isn't generous, so this is not a thing to put in a drawer until spring. And keep the evidence, the amended return, the letter from the pension provider, the proof of the date you stopped working. This process runs on documents, not on explanations. And here's the one I told you about, the one that happens to somebody who did nothing wrong at all. A married couple. Both on Medicare, both paying based on their joint return. Everything is stable. One of them dies. The survivor's income doesn't halve, but their filing status changes. After a period, they file alone rather than jointly. And the thresholds for a single filer are not the same as for a couple. So the surviving spouse can find themselves, in the years after a death, crossing a line they never crossed as a couple, with less household income than before, less money coming in, higher premium, and a 2-year lag. That means the change lands well after the funeral, when nobody is joining any dots at all. This is the single most avoidable unfairness in this entire subject, and it's the reason widowhood is on the list of life-changing events that the form covers. The survivor can report it. Most don't, because in the year after losing a spouse, filing an optional form about Medicare premiums is not what anyone is thinking about. If you take one practical thing from this video and you're part of a couple, let it be this. Whichever of you outlives the other will have a version of this to deal with, and telling them now is a kindness. Ed is back to the base amount and has largely forgotten the whole episode. Loretta too. And notice what that means. The expensive year was 1 year. Painful, avoidable, and finished. If nobody had ever explained the mechanism to them, they'd have concluded that Medicare is randomly expensive sometimes, and moved on. Which is exactly what most people conclude. Loretta claims her Social Security this year, having waited. Her monthly income rises permanently, a good outcome, and one she chose. It also raises her income, which sets her premium at 72. Nothing has gone wrong, but the shadow is still walking 2 years behind her, and it always will. And here's where the 2 ideas we've covered on this channel finally collide. At 73, required withdrawals begin. They aren't optional, and the amount isn't chosen. For someone who left a large traditional account untouched, that forced income can be substantial, and it arrives every year from then on, growing. That income sets the Medicare premium at 75, and at 76, and onward. So the decision made at 62 about which account to spend first, the one we spent a whole video on, doesn't just decide the tax on the withdrawals. It also quietly sets a healthcare cost 15 years later. Two systems, neither of which mentions the other, both keyed to the same number: your total income in a calendar year. Let me show you how these stack, because in a bad year they arrive together. Picture someone who retires at 64. Their final working year, 63, was a full salary, possibly with a payout of accumulated leave or a final bonus on top. At 65, they enroll, and the premium is set on that full working year. High. The same year, they start drawing from a retirement account to live on because the salary has stopped. That withdrawal is income, which sets the premium 2 years further out. At 73, required withdrawals begin, and those aren't optional. Another income increase, another shadow 2 years ahead. Every one of those is a normal, unavoidable step in an ordinary retirement. None of them is a mistake. And each one arrives with a delayed echo that the person feels as Medicare keeps going up. It isn't going up on its own. It's following them, 2 years behind, reporting on decisions they've already forgotten making. Now let me be honest about who should stop worrying, because I suspect a fair number of you are in this group. If your retirement income is modest, none of this touches you. The thresholds sit well above ordinary retirement income, and you'll simply pay the base amount, like Sam. This whole video is, for you, an interesting piece of information about other people. And if your income is very high and stays that way, a large pension, substantial ongoing investment income, then you'll be above a threshold every year regardless. The 2-year lag stops mattering, because there's no low year for it to miss. It's just a cost. This lands on the middle, and specifically on the transition. The person whose income is about to fall off a cliff because they're retiring, and who is doing 1 or 2 large, lumpy transactions in exactly the years the system will later look at. That's a narrow window of people, and it's a big effect for them. And one more honest caveat, because I don't want anyone doing something silly with this. Do not let this tail wag the dog. If selling a property at 63 is the right decision for your life, sell it. If a conversion genuinely saves you more over 20 years than one elevated premium year costs, do it. This is a cost to factor in, not a reason to avoid good decisions. The mistake isn't doing these things. The mistake is doing them without knowing there's a bill attached in a year you're not looking at. So which of the 3 are you? You might be Ed if you have one big transaction ahead of you. A property, a business, a concentrated position you've been meaning to sell. Ed's lesson isn't don't sell. It's that a sale you could split across 2 calendar years and a sale that lands entirely in one are different transactions in this system, and nobody at the closing table will mention it. You might be Loretta if you're doing conversions in the low window. That advice is good. I've given you a version of it myself. But the conversion that's cheapest on income tax can be the one that trips this. And the 2 calculations don't talk to each other. Somebody has to hold both at once, and that somebody is you or somebody you pay. You might be Sam. Sam did nothing and got the best outcome, and I want to be careful here, because the lesson is not do nothing. Sam got lucky. Sam had no big event in a year that happened to matter. Next time the dice land differently. And most people are a 4th person we haven't discussed. Someone who has already passed 63 and never heard any of this. If that's you, the useful move isn't regret. It's the form. If your income has dropped because you stopped working, that's exactly what it's for. So here's what to actually do, and it takes about 20 minutes. 1. Work out which year is currently your shadow year. Take the year you're in. Subtract 2. That's the tax return that's setting what you pay right now. 2. If you're not yet 65, do the same in reverse. Take the year you turn 65, subtract 2, and look at what you have planned for that year. If there's a sale, a conversion, or anything large and one-off sitting in it, you've just found something worth a conversation. 3. If your income has dropped because you stopped working, look up Form SSA 44. It's free, it's public, and it is the single most underused piece of paper in this subject. And 4. If you're part of a couple, whichever of you outlives the other will face a version of this with a different filing status. Tell them now, while it's an abstract conversation. 63. That's where we started. Not 65? 63. The year nothing happens. The year no letter arrives. The year that quietly decides what the letter will say when it does. Ed wasn't careless. Loretta took good advice. Sam wasn't clever. The only difference between the three of them is which calendar year a decision happened to land in. This isn't a loophole, and it isn't a trick. It's a 2-year delay in a filing system. And the only person who can see across that delay is you, standing on this side of it. Take care of yourselves. And take care of your money.